There's a lot of talk in the news about the AI bubble being similar to the dot-com crash in the year 2000. So let's take a look at the data. Right now we have 11 trillion dollar companies in the world, and 9 of them are actually AI related. So in this video, I'll be taking a look at the lessons learned from historical bubbles, and we draw parallels to it and how can you prepare yourself if the AI market crash really happens. Hello everyone and welcome to my channel. My name is John, a former engineer turned full-time investor, currently wealth planning director at Phillip Wealth and Phillip Capital. I actually help clients with a private mandate for globally investable stocks as well as Malaysian stocks. And I'm the author of an upcoming book called The Malaysian Multi-Baggers, which should be out in Q1 2026. So let's look at the current AI landscape. Is it really very much innovation or just an illusion? So right now, the S&P 500 has so much of a market concentration because 7 stocks now make up 36% of the entire S&P 500. That means the other remaining 493 constitutes only 64% of the entire S&P. So this is a level of concentration not seen since 1927. That's even before the Great Depression. And what we are seeing, why this overly concentration is really because of the blistering rate of AI infrastructure spending, and all the ecosystem players that are related to it are actually mirroring what we used to see in the past American economies, where the railroad evolution and also the internet boom evolution pre-2000, early 1990s to late 1990s. Even though valuations on market concentration are showing that it's really like almost like a bubble, but there is some economic substance to it, because unlike in the year 2000, as long as you have a .com name to your listed company, like pets.com, zero earnings visibility, PE of great companies or big companies, I wouldn't say big companies in the past like Cisco, or PE valuation 100, 200 times, the AI boom or infrastructure spending that you see actually trickles down in real cash flow to these companies. Companies like Nvidia, companies like Meta, who is spending, that have the money to spend from their ad revenue. A lot of it is really earnings growth, capital infrastructure spending growth since the launch of ChatGPT. Even though they were not the original LLM, I would say, founders, that had actually goes to a collection of other companies, but the boom was really triggered by the launch of ChatGPT, and ever since then there has been a feeding frenzy. Having said this, even though there is trickle down of earnings, capital growth, there is valuation worries, because these are valuations unseen now since 1999. The great financial recession of 2008 was very much a banking credit crisis bubble, whereas the dot-com crash was really this technological overdrive, overvaluation story. So history suggests that returns could diminish and all these valuations should actually compress. And I do think that we have to pay heed to some of these warning signs. So I'll give you 3 specific examples of what happened during the 2000 dot-com bubble. I think the first one, I will bring you geographically all the way to the north, which is actually in Canada. There's this company called Nortel Networks, and it is a very important cautionary tale because the stock actually represented 36% of the entire Canadian market index. One stock. Now you've got 7, the Max 7, representing 36% of the entire S&P 500, but that's 500 stocks. 7 to represent 500. Whereas in this one, Nortel represented 36% of the entire market, one company. The Schiller PE, price to earning ratio, reached 60.62 before crashing and dragging down the entire Canadian index by 43% over the next 2 years post 2000, right? That's the first example. The second example of a bubble was actually the rise of Japan. And in the 1980s, it was the roaring tiger of Asia before Malaysia kind of took the title for a while. Japan had surpassed the US as the world's largest stock market at that point of time. Peak valuations, extreme valuations. It crashed, and then when it adjusted for inflation, it has not recovered 36 years past that point. So just imagine, it didn't help that they also had a property bubble where property prices were just driven to insane levels, and today it's not even really recovered. We're seeing some of those similar things happening in China, where the real estate bubble has actually kind of like burst in bits and pieces over here, over there in China. So it's very similar. Government was just, lax fiscal policies, monetary policies, credit, build infrastructure to actually stimulate the GDP growth. And once a bubble actually happens, especially in the case of Japan, it's not recovered since. And last but not least, the US.com bubble, invested paid high prices for promise of future earnings that never materialized. Companies like Cisco, even though they had earnings, were bid up to like crazy high PE valuations. And that really led to the lost decade, the year 2000 and to 2010. So for some proponents, it says buy the index and just go away, right, and just let it compound. If you bought the S&P indexed ETF from year 2000 until 2010, literally you made zero. It was actually a flat line. That was the lost decade I'm actually referring to, because the first crash was the dot-com bubble in the year 2000, followed by the great financial crisis in 2008. That was a double whammy, and you only saw returns post 2013, which was 13 years after the dot-com bubble. So if you invested in the index, that 13-year period, you have literally not made much capital gains at all, unless you individually pick stocks that rise regardless of the index. So now let's draw deeper parallels to what happened in 2000 and 2008. Much like today, the 1990s saw massive investments of revolutionary technology. One example was actually fiber optics. I mean, that improved the speed of communication, but that golden age of investments actually bankrupted a lot of initial investors, because following the hype, following a lot of these demand, insatiable demand for infrastructure to build, if we draw lessons from there, it's very similar to how the hyperscalers are building just large gigawatt, not even megawatt, gigawatt size AI cloud centers, cloud data centers. I think that's where we have to temper the caution of, how are they going to make money? Because your $20 US dollar subscription to a ChatGPT or through a Gemini or whatever, at this point of time, at every subscription, it's not going to make money, or not even breaking even for ChatGPT. So the monetization of these AI products are yet to be seen. And while the infrastructure build up is necessary to achieve that kind of scale, but the visibility of earnings is still a very big question mark. The reason why these guys can actually survive till today, because, for example, Google, Meta, they are getting revenue from other sources, not from AI subscription. They're getting revenue sources from advertisements, cloud subscription, like for me, for my business, and then other products like Mayban launching their Meta glasses, the Ray-Ban glasses. So these are revenues or profits that actually help offset a lot of these AI investments. Okay, so 2008 was another crisis, subprime mortgage, and while the market was just about to recover from the tech bust, 2008 just hit it, double whammy, and then it prolonged the misery of the US investor. And then only 13 years later, in 2013, that they break even. And if you look at the last parallel, is actually this concentration risk. Canada was so much concentrated into Nortel. Right now, the Max 7 concentration is also not super healthy for the market, especially the index. It's so much concentrated at the top. So I guess as contrarian investors, we have to be aware when valuations hit peak like this, and try to structure the portfolio in such a way it will be resilient. I'll talk about more of this later, on how you should uncorrelate the industries and the stocks you have in the portfolio. So what is the portfolio strategy I adopt? Unlike most funds which tell you, we invest in Asia x Japan, meaning they invest in Asian equities minus Japan as a geography. I don't believe in that kind of strategy. I don't believe in segregating your stock investment portfolio based on geography, but based on supply chain and based on industry. And I think a globally diversified portfolio was what saved people who invested in Japan, because when the Japanese market crashed in 1989, the globally diversified investors did just fine because they held US markets, which actually saved their portfolio. So back to the investment strategy I mentioned about, if you invest based on industry, supply chains, or value chains, um, the best players or the best peers within a particular industry may not be geographically confined to a particular country. Most of them will tend towards to be in more developed countries like the US or Europe or Japan or China. But if you look at today's business environment, it is really a very globalized supply chain industry, and we should not just confine ourselves to thinking about geographical regions, right? The second thing we do and how to prepare is really the value safety net. We have to be very, very disciplined on not overpaying for things. So as I mentioned, 36% of the S&P 500 is concentrated in the Max 7, right? And if you're going to chase after this, and it is exacerbated because an ETF, the higher the market cap of a particular company and the weightage, the more an ETF or index fund will buy into it, obviously perpetuating the concentration even more, right? The real value is really looking for value or small cap stocks, or stocks that have been out of fashion, boring, old, right? Not adhering to the narrative of AI. This is where if you have the patience, if you're willing to do the due diligence work, this will actually deliver better or more likely to deliver positive returns over the long run. Because the moment a tech index actually crash and it comes down maybe, let's say, minus 40% in the past, then what will happen is that because if you stuck to a discipline of buying value, then the crash will not be so much impacting your portfolio, right? The third strategy is really about moderating your expectation of growth, because if you find a good company, most likely the market knows about it. There's already a price discovery, and people are willing to pay higher valuations. But that margin of safety and the growth rate, I mean, if you find a company that's selling to you at P of 100, but it's growing at 150, 200% every year, how do you ensure that sustainability of growth will happen? And how do you know when you're paying for a P of 100 times or ROIC of that high? How do you know it is sustainable over the long run? And that's something that, there's no right or wrong answer. It requires a lot of judgment. But the discipline to not overpay for something is what makes portfolio profitable over the long run. So as a final checklist for investors out there, and it's something that I apply on my own, is your portfolio first item, is your portfolio overly reliant on the Max 7, Magnificent 7? Even if they're great businesses, extreme concentration can really lead to substantial market declines if those few stocks get hit by an AI bubble, right? Secondly is, what is an average valuation that you are paying for the multiples of this earnings that you're concentrating in this Max 7 or any AI stock, right? If you are paying price to earnings growth of more than 2%, where is your margin of safety? What if the negative happens? Where is your protection mechanism against overpaying in the first place? Third thing, and I think it's very, very important, is that don't be geographically confined, don't be industry confined. I think over diversification is also bad, but if you concentrate too much into a particular sector, there is so much correlation risk that you actually not protecting or not safeguarding your portfolio, right? So diversify to a point where there is uncorrelated industries, hopefully spread across different geographical regions or different supply chains, but at the same time not over diversify that you become an ETF. Then you might as well just buy an ETF, right? And last but not least, I think the discipline to do the due diligence, not overpay. One of my own learning points is really, if I look back, why I actually overpaid was because I've not scoured the universe big enough. I've not done enough work to find value, and that's why you say, okay lah, I think this one grow like this at this rate, I'm willing to pay, because you've not done a wide enough casting of your net. And that's where I think by constantly doing the work, constantly looking out for ideas and looking out for quality businesses, I think it will help you in maintaining that discipline not to overpay. So those are my quick reference guide and how I safeguard my own portfolio, my client's portfolio, and something that I think you should also help structure for yourself. And if you need help, to do an audit of your portfolio, more than happy to, oblige. Let me know in the comment section, or let me know, through a DM or through an email. Looking forward to seeing you in the next video.